Joshi sir, thank you so much for whatever input that you have given, but there are several questions which are unanswered. One of the area which I would like you to express is about the legal or regulatory provision. As also I would like you to highlight on the digital currency and the nuances of digital currency, how it's going to impact the banking sector in general and the urban cooperative banks specifically. Sir, please.
Yes, sir. As I told you, the Indian currency consists mainly of two types. Either they will be banknotes, currency notes, which, as I told you, are promissory notes signed by governor in various denominations, and other is coins produced by Government of India. But in the new era, modernization, new ideas, so many other instruments are also working as cash. They are exchanged for value, like even ATM debit credit cards, they do function as cash. Now this GPay, Phone Pay, Google Pay, all are sorts of currencies which you can use for the exchange of value, followed by a digital currency. As you all know that this cryptocurrency entered India, and many of the investors were taking advantage to invest in cryptocurrency and booking the huge profits. In Russia and Nigeria, these countries, this is a common feature. Cryptocurrency is mostly used, but in India, it had no support of central bank. Unless and until Government of India and central bank approves the currency, it cannot work as official currency of the country. And although some people were using it, reaping the huge profits out of fluctuations in the prices of this type of currency outside, government was not in favor. But since the use of this currency increased, digital rupee, RBI thought in March 22, this budget session, our Honorable Finance Minister agreed that yes, if people want it, we will launch a digital rupee, and through RBI only we will have digital rupee with us for retail segments. And now from December 2022, this digital currency has been launched. Digital rupee is a central bank digital currency. That is called CBDC, central bank digital currency, which is similar to regular currency notes issued by RBI, but they are not in physical form, they are always in electronic form. Now this currency is backed by RBI. Also, along with traditionally currency notes used by the people, this is also approval of central bank, and central bank has approved. It will be launched by RBI, basically replacing the traditional currency notes, because printing of currency notes, putting them into circulation, taking it back, destruction of the same is a huge process which is costly one, very costly process. That's why the currency notes, RBI wants to replace these traditional currency notes in the wallet form, and could be made use and receive the payments via QR codes. So through digital rupee wallets held by payer and payee, these transactions will be done. You will just ask me, what is the difference between this, how it is different from UPI transactions? UPI transactions involve entries in both the banks' account statements, which are maintained by commercial banks or all banks. Since e-rupee, that is digital currency called e-rupee, is its main objective is to replace the cash in your wallets. It is a central currency. It would not make an entry in your commercial bank account, and its records will be maintained by RBI itself centrally. So there will be no entry in the accounts book, but your wallet will be reduced to that extent. The selected banks have been given this power to fill up the wallets of the people. Like any other cash withdrawal from your bank account, you will put the amount of currency in the bank, and your wallet will be filled up with the digital currency, which you can use as from the cryptocurrencies were based on blockchain technology, and it was recorded for everyone to see. But e-rupee, though said to be based on blockchain technology, records of transactions will not be publicly available. So that is the difference between the digital currency and the important currency. And anybody, e-rupee is not an instrument which would earn you any interest on the deposits. It is simply in the form of electronic cash, and you can use to transact through these wallets. Most thing is why at all? What are the advantages of digital currency? Friends, as I told you, printing and handling of cash, it has got cost, and a huge cost. So to encourage cashless economy, digital currency has been introduced. Main motive of digital currency introduction is to reduce the physical form of currency and replacing it by cashless economy, cashless transactions. So smoother and faster flow of transactions is possible. Then cost of UPI transactions is reduced, and also it is alternative to cryptocurrency for various reasons, as I told you already. So there is a digital currency now in use. Slowly and slowly, I am sure this will be liked by the people, which will replace the traditional exchange of currency notes. Carrying the currency notes, as I told you, it is very costly thing. That's why the digital currency is most important. Another aspect I wanted to emphasize is, as I told, we discussed earlier also, what are the legal provisions which empower Reserve Bank of India to do this function of currency management. As I told you, Reserve Bank of India Act 1934, section 22 to almost up to 40, they are giving so many powers and provisions concerning the cash management, the currency in circulation. So section 22, some of the important sections we will discuss. Section 22 says there will be a sole right to issue banknotes in India. Who will have? The Reserve Bank of India. Reserve Bank of India will have sole right to issue banknotes in India, and no other agency or bank will issue the banknotes. So banknotes as well as coins, both are always put into circulation through Reserve Bank of India, which is central bank of the country. Next is, these banknotes, currency notes, will be kept in a separate nature in the issue department or vaults of the, it will be brought from the currency printing presses to vaults of the Reserve Bank of India or central bank. Now this one more term you should be conversant is currency chest. Currency chest is a place in the, that is a rented place used by Reserve Bank of India in the vaults of commercial banks or other banks, big banks, where cash belongs to RBI and not put into circulation is stored there. So as and when they feel necessary, they can withdraw from the currency chest, they can again deposit into currency chest. So this currency chest mechanism is also important for management of currency or cash. Another section, very good section, is section 24 of this act, says the banknotes shall be issued in the denominations of 10 denominations have been given. The denominations are, as you know, so central government will direct and approve the size, design, form, material of the banknotes. Then it is a legal tender. Another section says it is a legal tender. Legal tender in India and guaranteed by the central government. All the banknotes are legal tenders in India and they are guaranteed by the central government. Section 27, most important, is because it is a clean note policy, is out of this section. RBI Act specifically says that no torn, defaced or excessively soiled notes will be put into circulation or will be reissued by the bank. So under this section only, all cashiers, they are required to see that the notes are clean, they are not, soil notes are sorted out, all types of torn, impounded notes should be taken away from the currency, and only good notes should be in the hands of the public for use. And that's why we are even pinning the bundles of notes, packets of notes we have dispensed with. Very few countries are now using this. Almost all the countries in the world, there is no stapling of note packets. So we are also using that. And now no torn, defaced or excessively soiled note, all these notes have to be sorted by cash department and they should be deposited in the currency chests or sent back to RBI for withdrawal of these notes. Another very important section of this act is section 28, which says no person in India can claim it as a right, the value of any stolen, mutilated or imperfect note. As I told you, this section, when it says that no person can claim it as a right, you cannot go to RBI and as a right you can claim the value of your soiled note or imperfect note, torn note into pieces and pieces. But the same section, there is a proviso. Reserve Bank of India will make rules under this section, which are called, very important rules, note refund rules. Please see that in RBI site, RBI website, rbi.org.in. This note refund rules have been placed. All the cash department people concerned with cash who are facing these notes day to day, and people are coming for exchange for value of their torn note, soiled note, imperfect note, torn note, they should be able to understand whether and how much exchange can be given. Soiled note, please remember, is a perfect note, only it is because of excessive use. All silent features are present there, but only for excessive use the note is soiled one. It can be freely exchanged, and this, the main motto of this or main purpose of the Reserve Bank of India is that only clean notes should be put in circulation, and such notes should be given exchange. They should be exchanged with good notes, and that's why the note refund rules have been formed, and these rules are have been put in the website of RBI. Another, please remember as a general knowledge, when RBI issues currency notes in the hands of public, it is a liability of RBI. It is being a central bank. It is a liability. Two and above notes are liability because it is a promissory note given to the promise of the public. I promise to pay the bearer a sum of rupees 5, 10, 20, 50. So total notes in circulation is a liability. Equal assets are in the evening. This Department of Currency Management or issue department will consolidate the notes in circulation as the close of the business, and equal assets are created to equalize or to support this type of liability. And
Joshi sir, thank you so much for whatever knowledge that you have shared with us. There are still areas where you can shed some light in order to help our banks to manage the show. One of the critical areas which I find where banks should pay proper attention is the liquidity risk. I would like you to talk about liquidity risk and the apparent tentacles of liquidity risk that will be a great help to the urban cooperative banks in the country. Sir, please.
thank you, sir. Really, as you told, liquidity risk is very, very delicate and important and unavoidable risk for the banks. As you know, banking is a business, and every business, including banking, has got risks in the business. You cannot avoid the risk. Risk has to be minimized, managed, and mitigated. Total risks cannot be avoided. More the risk, more the profit. But only thing is that scientifically, you should be able to minimize it, manage it, and mitigate it, because these risks will cause a huge damage to your financial position, profitability, if it is not managed properly. In the world or in the area of banking, only three risks are important. One is default risk, that is credit risk. Next is market risk. And third is operational risk. All these three risks are very important, but along with these risks, we have got small but very important risks. That is, one is concentration risk is also there, compliance risk is there, reputational risk is there, legal risk is there. Along with that, liquidity risk is also there. Liquidity risk, in short, is when it will arise, when you want liquid cash for outflow of cash and you are short of cash, you are not able to raise the cash with minimum cost and minimum time. We all are bankers, you know, we are facing mainly two types of risks. We have to, first risk is on the liability side. We have to repay the resources raised in the form of deposits. Either they are demand deposits or they are time deposits. So there is a risk. If you are not able to repay as per mandate, either on demand or on expiry of term, immediate bad message will prevail in the market, and if you are not able to repay the deposits in time, run on the bank is must. Another, on the asset side, there is a big risk, because in the banking business, as I told you earlier also, liabilities are accepted first. Assets like loans, advances and investments are created out of liabilities accepted. So these two assets they are the most earning assets, give you most of the profit. So these two assets should be performing one. That's why when in the default risk, when our installments or interest is coming irregularly, we called it as performing asset. If there is a default in either of the two, it is a non-performing asset. So liquidity risk is important in the form of asset liability management. Asset liability management takes care of the risk management, including the liquidity risk. So liquidity risk is as and when you want liquidity to repay your liabilities and keep your words, that is called liquidity risk. This bank's solvency fully depends on your strength of the bank. The strength of the bank is affected if your liquidity is not proper, and your solvency should be kept intact, and your liability should be, you should be able to pay back as per your contract with the customers or depositors. Then liquidity risk. Please remember, when liquidity risk arises, it is cash inflow and cash outflow. These two things are important and they should be matched together. When maturing liabilities is outflow and maturing assets is an inflow, if there is a this maturity mismatch in both of these two, either of these two, then liquidity risk will arise. So banks are functioning, please remember, banks are functioning only on one principle, that whatever people have deposited money with you as a deposit, they don't come at a time, all the people, to withdraw entire money kept with you. That's why you dare to advance it to others, third parties, and earn the interest. So liquidity is required to repay the liabilities you have raised. Either they are demand deposits or they are time deposits. So these type of mismatches should be minimum one. So RBI has issued one very nice circular on asset liability management, and we all are having software also, ALM software, from where you take out structural liquidity or inflow outflow mismatches, interest rate sensitivity statements. So these statements are nothing but risk management measures against the liquidity risk. So this liquidity risk is most important, as I told you, for risk is managed by banks themselves. RBI wants the risk management to be looked after, and they should have risk management department, they should have risk manager with them, chief of the department. But I tell you very firmly that RBI itself is your big risk manager. RBI takes care of your risks. Especially we are discussing liquidity risk. RBI, in addition to your cash in hand and balances with banks, if you are in need of further liquidity to repay your deposits, RBI has stipulated two important legal requirements. One is in the form of cash reserve ratio, other is in the form of statutory liquidity ratio. In deep, I will not go into the provisions of this, because these requirement percentages of this is always announced by RBI. They are supported by either RBI Act or BR Act, both of them. In every 100 rupee deposit you accept, 4 rupees are to be kept as cash separately in your pocket. 18 rupees you have to invest in government securities. So these 22 rupees is also a liquid asset. At any time you can liquidate the government securities and raise the liquidity, or any time this money kept aside as CRR can also be used in case of risk, liquidity risk. So this provisioning of CRR and SLR is also a important one measure by RBI against the liquidity risk. So this liquidity risk, as you know, liquidity risk is important because it will cause damage to your reputation and it will cause a run on the bank if you are not able to give back the deposits or liability. So also in the banks, RBI has told to have ALCO as a committee. One of the committee to support board of directors, banks have so many committees. ALCO is the only committee where no director is a member. Asset liability committee, that is called ALCO, is a committee where all departmental heads and your CEO, MD, top officials of the bank representing various departments are members. They have to meet frequently to take stock of the funds management, liquidity position of the bank, liquidity risk of the bank, and the interest rates on deposits, as also which are expenses, and interest rates on advances, which is your income, have to be studied properly, keeping in view the requirement of your funds, keeping in view the market position, keeping in view the rates, prevailing rates by your competitors, attracting the deposits. You have to decide what should be the rates of interest on deposits, what should be the rate of interest on advances. So this ALCO also takes care of liquidity risk and funds management. So please remember, in short, this liquidity risk is very important because it will cause damage to the image of the bank if you are not able to meet the liquidity properly. Also, it will cause very important risk for bank because it may turn into a run on the bank if you are not able to do. So in short, please take care of the liquidity risk. RBI is all the way helping you as a risk manager. It issues so many circulars on all the aspects, not only this liquidity. So please see the RBI.org.in all the time. All the bankers and especially the MDs and CEOs should read, study, and put up before the board the follow-up actions, the meaning of various circulars for issued for liquidity purpose. So please, liquidity risk should be managed properly so that we are strong enough in the banking sector.